Dudley, I look at where we are in the greater theme of things, and there's going to be a point now, maybe a point in the future, where the day-to-day work of the Fed to support the economy is over, and they begin to pull away from the monthly fundings that they're doing. They pull away from the jargon and the speeches of providing ultra accommodation. Are we close to that moment?
No. The Fed basically has told us that Chair Powell has said it's premature to be talking about even beginning to, wind down the rate of asset purchases. So the Fed is probably not going to do anything different for at least until late fall, early next year.
Well, that may be the policy as well, but then we go Fed meeting to Fed meeting. You've been in the crucible of this, Bill Dudley. Little sentences are given out in speeches from, say, Cleveland, from, say, Kansas City, from San Francisco, or from the pressures you faced at New York. Are we going to see theory come out in the speeches of federal officers in the coming months?
Well, it really depends on, how strong the rebound in the economy is. I mean, what we're hoping is people get vaccinated, and once people get vaccinated, social distancing can be relaxed, the economy can be reopened. And when that happens, the economy should accelerate pretty sharply because you're going to have a big increase in demand in the leisure and hospitality area in particular. People are going to go to movies, they're going to go to restaurants, they're going to travel. So that could be a pretty strong second half of the year if things go well. And I think at that point, then people will start, at the Fed will start to, begin to think about, okay, how do we start to pull back? But the Fed doesn't want to pull back prematurely because there's still 9 million people that have lost their jobs since the pandemic started. And so they don't want to pull back too early because if they do, bond yields will go up, the stock market goes down, that tightens financial conditions, and that makes it harder for the Fed to achieve its objectives.
As we get closer to running the economy hot, Bill, there's a question of financial stability risks and how you measure it in a time of shadow banking, at a time of Robinhood traders, at a time of other structural changes to the market. You put out a column about this. Do you think the Fed is gauging systemic risk correctly as they look forward to a perhaps hotter economy?
Well, I think the problem that they have is that at some point they are going to have to turn the dial back away from, significant accommodation. And when they touch that dial, or when they're perceived to about to touch that dial, markets are going to react. So I think it's going to be very difficult for the Fed to, avoid a bond taper tantrum. You're either all in or you're not. And at some point, the Fed's not going to be all in. And when that happens, markets are going to react.
In some of the risks that you put out there in this column that you wrote this morning for Bloomberg Opinion, you mentioned mutual funds and ways to protect against runs on these particular funds. Do you actually view this as a real viable risk going forward if there is some sort of taper tantrum like you're saying?
Well, it depends on how violent it is. But, the problem we have is we have mutual funds that invest in very illiquid asset classes like high-yield debt. And yet we offer these mutual funds, and we basically tell people they can get their money out overnight. And you can't actually, if a lot of people show up at that mutual fund to get their money back, the market really can't absorb that much mutual bonds being sold into the market. So it makes sense for illiquid mutual funds to basically tell people, no, you don't get overnight liquidity, you get weekly liquidity or monthly liquidity. And that gives the mutual fund manager time to actually liquidate their assets in an orderly way so that you don't have the fire sale of assets, which would obviously depress prices even further.